and welcome to the Fundamental Value Podcast, hosted by Joshua Frank, co-founder and CEO of the TI. On Fundamental Value, we speak with leading analysts, traditional finance and digital asset firms, and investigate how leading minds in the cryptocurrency space research, analyze, and quantify the value of digital assets. Quick disclaimer, this podcast was recorded and is being made available solely for informational purposes.
Today, I am very, very, very excited to be joined by Matthew. Is it Sigel? Matthew Sigel or Siegel?
Sigel.
Sigel. Matthew Sigel. I was looking for the E there, but Sigel. Got it. Head of digital asset research at VanEck. Matthew, it's so great to have you on.
Thanks for having me.
So, Matt, can you walk us through your background pre-crypto?
Sure. I started my career as a news reporter covering finance at Bloomberg and CNBC. So kind of watched how the narrative of our mass media coalesces. It's not a very pleasant experience. So got disillusioned with that, got tired of interviewing people with bigger balance sheets than me all the time. So I got my CFA and kind of networked my way until I found a PM who wanted to hire me, and that was Kathy Wood before she started ARK Invest in the AllianceBernstein days. So spent 4 years at AllianceBernstein working for Kathy, covering tech, Web2, cyclicals, and kind of everything related to innovation and disruption. From there,
Please. No, I was going to ask really quickly before you continue. Obviously, the AllianceBernstein on your resume as a portfolio manager makes a little sense now. But can you kind of go into like what your take is on Kathy and your experience working with her, and kind of obviously ARK has been in the news for not necessarily the best of reasons recently. Kind of your take on everything that's going on there before we kind of continue, just out of curiosity.
Sure. Kathy is a tremendous risk taker who is constantly kind of on the vanguard of like what's going to be the next innovation and what's going to disrupt existing business models. And she doesn't have much time for benchmarks. And so, the funds that we were running, although, nominally benchmarked to the S&P 500, exhibited a lot of volatility, a lot of tracking error, definitely some alpha over the years, but it was a wild ride. Learned a lot. The focus when I was there was internet companies, Amazon, open source software companies like Red Hat. We were early into kind of virtual items in gaming. So now that when I look back on those days, I can see the writing on the wall of how we both arrived at crypto kind of separately, because when I left in 2011, there wasn't really any Bitcoin. So I got steeped in the network power, the Metcalfe's law, and how these asset-light platforms were just inherently going to print bigger margins than their competitors. And even when I left Kathy in 2011, I spent 10 years in investment banking, research, and sales, writing kind of multi-asset strategy, covering stocks. I always had in the back of my head, what are going to be the companies that disrupt these Web 2 giants with their massive margins? And I sure hoped it wasn't going to be regulation, but my antenna were up. And when kind of the FANG stocks started to take a disproportionate amount of the market share of the S&P 500, and I was doing a lot of research into Google and watching the demise of the news industry where I'd spent so many years, and you could see Google's top line versus the total employment at newspapers and magazines, these charts that crossed in like 2009 or 2008. And then I learned about this technology, cryptography, which had been really kind of an ivory tower technology, right? There was some mathematical innovation in the 70s. That knowledge was really kind of kept by governments and universities, and the internet came along and democratized all this information, and suddenly everyone had access to the underlying cryptography. And that, on the back of that, came Bitcoin, which was, as I saw it, kind of the killer app 1.0 of cryptography that would democratize finance. And it was missing and still is missing a lot of features that have been added on with other coins. But at least I, in 2017, got conviction that Bitcoin was going to be a big deal and started buying.
And so what made you kind of make the decision to go from just being a purchaser of Bitcoin and somebody who was tangentially involved to actually moving into the space full time? And I know we spoke about AllianceBernstein, but maybe you could speak about the other things that kind of were in between, your experience with Kathy and then coming into crypto, and what kind of made you make that switch.
Yeah, sure. So 2017, I remember staying home from work one day and telling my boss I had to read this book about blockchains, and he's like, "What the F?" And that was kind of how I got conviction on.
What was the book, by the way?
Oh man, well, it was some, like, I don't even remember, to tell you the truth. It was like how blockchains work, right? I can send it to you for the show notes. It was pretty dense stuff, but I kind of put it on the back burner. The day job in investment banking was going okay. I was like auto buying some Bitcoin every once in a while. And when COVID came around, really, and for me, it was the true demise of the mainstream news industry, right? Suddenly, nothing I was reading in mainstream media was making sense. And it seemed like there was just this kind of two-track path on what is the truth. And that can be demoralizing, but it can also highlight technologies or situations where the truth is very evident. And on the blockchain, on the Bitcoin blockchain, every 10 minutes, everyone on that network can coalesce around what is the truth. And that, for me, was a really powerful dynamic that I was sure was going to grow in value over the years. At the time, I was working for a Chinese investment bank. So this is, Xi Jinping taking power, consolidating, really starting to crack down on the internet companies. And that was, kind of the writing on the wall that, okay, this COVID is going to empower governments to take a lot more control than they had in the past. There's going to be secondary effects to that. A lot of things are going to get distorted, monetary policy, obviously. And, this is right around DeFi summer. So if Bitcoin was killer app 1.0, as I saw it, smart contracts were killer app 2.0. That was what was going to bring programmability to the blockchain and enable all types of microtransactions that weren't economically rational. So I had a opportunity to meet a very inspiring, aggressive CEO who wanted to grow his crypto business, and that's what we've been collaborating on for the last year and a half here.
Yeah, and so can you speak, a bit to what VanEck is more traditionally? I mean, I know a lot of folks that are listening are probably familiar with the firm, but I'm sure not all are. So what VanEck does more traditionally, and then how the firm is kind of operating in the crypto space, because VanEck was actually, and I think people that have been in this space for a while know this, but VanEck was very, very, very early to crypto. And so kind of speaking about, the traditional side and how you're operating in crypto and kind of the core offerings in the space.
Sure. There are actually a lot of synergies, and it goes back to the history of the firm. So this is a firm that was founded in 1955. It's a family-owned firm. The founder's son is the CEO now, so his name is on the door. And the way that the firm got prominence was in the early 70s. The current CEO's father was running this international mutual fund, which at the time was pretty innovative in itself, non-U.S. stocks. And he observed what was happening with the U.S., about to go off the gold standard and eventually doing so. And he pivoted that international fund into almost all gold mining stocks. So that was a home run of a call. The fund was like the best performing mutual fund in the US for the 1970s. And that really catapulted VanEck to where it is today, which is dominant in gold mining and resource equities. So we have the largest gold mining ETF, GDX. And so when Bitcoin came around, Jan, CEO of the firm, was highly attuned to the potential disruptive impact on our core business, which are these gold mining stocks. So you're correct that we were among the first to file for a spot Bitcoin ETF. That has turned out to be a sideshow. 5 years later, still not approved, but we're not the type of firm to sit still. So when we couldn't get that off the ground, we've spent a few years making a number of private investments across the space. So we've made private investments into exchanges like Gemini, FTX, Binance, a whole number of kind of emerging markets-based exchanges where oftentimes the technology disruption happens quicker because they'll skip an intermediate technology and go, straight to the good stuff. Think like skipping the fax machine straight to email. And we also made a number of investments in venture capital firms across the space, including seeding an early stage fund where we now own a part of the GP. So those private investments gave us access to people. They built our network, and they allowed us to enter into commercial agreements with counterparties who might not have paid attention to us because we're not native crypto. So writing those checks was very helpful. And then over the last year and a half, we've introduced more than 15 separate crypto strategies. So in Europe, where regulation is much easier when it comes to listing these funds, we've got more than a dozen single token and multi-token crypto funds that trade as exchange traded notes on Euronext and SIX and all the European exchanges. And then here in the US, we have 3 hedge funds. Because of the regulation, we can't list these token funds. We're not a big fan of the listed OTC strategy that some of our competitors are going down, where you get these very wide premiums and discounts that don't make for a very pleasurable investor experience. So we've done the private route, and we now have 3 hedge funds in the market as well.
Are those hedge funds like active strategies? Or are they more kind of, look more like ETFs that are just private and can't be listed?
They're more like active strategies, but they have a variety of kind of risk and return. So one of them is a lending fund. So we lend dollars short term to CeFi players, and that might sound like a challenging strategy given the events of the last few months, but we've managed the downdraft quite well. We've never had a down month in that fund, and it's really about counterparty selection. So we spend a lot of time talking to the exchanges, the OTC players, the market makers about their onboarding processes, how they handle risk, what their loan books look like. We sign NDAs to get what we can, a peek of the books, and we're just performing traditional credit analysis, limiting our counterparties to a very small number who have large balance sheets and sophisticated risk management techniques, and essentially lending overnight dollars. So it's like a digital commercial paper fund. So that is definitely actively managed. You can't replicate it in ETF form in any way.
Yeah, of course.
The second fund, which I manage, is called Smart Contract Leaders. That is an actively managed kind of index fund. So we did a taxonomy of the space. We classified the top 300 or so crypto assets into 8 sectors, and then we commissioned our index subsidiary to create indices based on these sectors. And then when we did the fundamental work, one of the sectors, smart contract platforms, kind of stands out as most investable, most liquid, the largest total addressable market. Think Ethereum as being 30 to 40% of this index at any given time. And then I actively manage a fund that tries to meet or beat that index at kind of a predictable level of tracking error and turnover. So it's a beta product. It's not a performance fee. It's a straight kind of assets under management, 1% fee. And then the third fund that we've recently brought to market, we hired a portfolio manager from Millennium with a traditional credit background, and have launched a more opportunistic 2 and 20 hedge fund that will buy really anything, any token. So those are 3 private fund offerings that we have.
Had VanEck had a hedge fund offering before, like an active managed fund like this Millennium PM is going to be running? Or is that a new concept to the firm?
We did have a pretty big hedge fund business about a decade ago, multi-billion dollars in hedge funds that as things happen, they're cyclical. So that business didn't exist in its current form when I joined.
And VanEck is making a big GP contribution to this fund, and then basically bringing in, like, who are the LPs in the fund? Is it like people that are traditionally investors in a lot of VanEck's other products from an institutional point of view? Are you bringing like a lot of traditional, pensions and endowments into this fund? Like where's the interest that you're seeing?
Yeah, so like our traditional channel is registered investment advisors, pension funds, institutional investors, wirehouses, are big partners of ours. Those are not really the first movers when it comes to crypto. So while we have had some success in that arena, and we recently signed up Fairfax County's pension fund for to come into our new finance income fund, that lending vehicle. There are some hospital chains that are LPs. There's an insurance company who's got their general account in my fund. So there are some traditional institutional investors that are early here, but then we've had to be more flexible and explore the family office route as well, because those have just been the kind of the early allocators to this space. My observation from talking to a lot of clients and prospects is that there's definitely a lot of work being done by consultants, pension funds, all of your traditional institutional investors, ex the banks, feels like are getting there. But then if you go across the pond to Europe, it's a completely different and much more bearish backdrop where the institutional investors are nowhere
the LP
close.
base historically more US centric or European centric for the firm? I'm assuming it's US, just based off where you're domiciled.
More US, but we have operations in Europe, wholly owned subsidiaries in Europe and Australia. Those are multi-billion-dollar businesses as well. But I just find it ironic, I guess, that on the listed side you can do so much more in Europe, and yet the institutional investors are so much far further behind.
Yeah, it's interesting because people tend to view at least institutions as Europe as being very, 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 very risk averse. But then the actual listed products, it's interesting. It also in some ways, though, speaks to the fact that some U.S. policy maybe doesn't make all that much sense as it relates to ETFs. I'm sure you have an opinion on that. Like the fact that the spot ETF and the futures ETF have the same underlying index, yet they can't get approved. So I don't know if you have a thought on, just on that note, where we are from a regulatory point of view on ETFs and whether or not you think we're at this point, it's even anywhere near, is in Gensler's term as SEC commissioner, do we even have a chance of seeing an ETF approved?
Can you predict the outcome of a hostage situation? Because that's really what it is, right? Is the chairman is holding outcome is usually the ETF bad. Hostage.
Just how bad the hostage situation is.
Right. Sometimes the criminal in the hostage, continue the hostage analogy, like gets tired and resigns. So that's a potential outcome. But we're at a loggerheads, and as you note, the logic doesn't make a ton of sense as to why this hasn't been approved. So we just put it to the side and deal with what we can do, which is right now pick the tokens that go up, hopefully.
And so I think that's a great segue into what is your role as head of research and TAL? So I know you mentioned that you're kind of like acting as kind of like a portfolio manager for this smart contract fund, but what does it really mean to be head of research at VanEck, for head of digital asset research for that matter?
Yeah, so I coordinate the firm's crypto research, manage a team of analysts who are digging deep on individual tokens, run one of our funds, as I mentioned, and then help the firm with our private investments, which include these 5 different VC firms, and a kind of our one-off private stakes as well. And that includes, dealing with exchanges and data providers, understanding and hopefully underwriting the tokens that we own, managing position sizes in the fund that I manage, and communicating essentially with everyone internally and externally to make sure all the knowledge is known by all.
And so, didn't have this written down, but I think it's a worthwhile question. You got as an LP in 5 VC funds, and also, I'm familiar with the fund. You're a GPN, big fan of the 2 founders of that fund. They're awesome. They've had a bunch of great bets. where do you see the VC space in crypto going over the next 6 months to a year? In terms of like, do you think there's a lot of dry powder out there? Do you think this is kind of like a lull? Do you think the space ultimately corrects? I mean, my honest opinion, being a founder, is that valuations were stupid. They didn't make any sense at all. I mean, it doesn't take a rocket scientist to see that a $90 million seed round pre-product is a little bit asinine, for lack of better terms. But that's just my opinion. I'm curious as to yours.
Yeah, totally agree. And thanks for the shout out on Cadenza, Max and Kumar, who've done an excellent job with that fund. And they raised $50 million more than a year ago and have only deployed 40% of it. So they've done a great job of kind of waiting for the deal flow to calm down a little bit before writing some of these checks. But yeah, valuations were ahead of themselves, but there's $7 billion of dry powder was the last number that I saw in cash by VC firms who are ready to write checks. I think,
and that also doesn't include all of the traditional funds that, like, I mean, there's a mill, I mean, that have put checks. I mean, you go down the list of like your Warburg Pincuses and your IVPs and your blah 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 whatever. There's a Battery Ventures. There's a million traditional funds that are 2, 5, 10, 20, 30, 40 billion in AUM that are still putting checks in the space.
Yeah, I mean, we like the seed stage and early stage, and think that's the most pure, and that's where there's going to be pricing power, because some of the kind of later round growth oriented VCs, a lot of times they're sitting on tokens, they're buying tokens in the open market, and they're locking up for 7 years and charging what they're charging. It feels like not a business model that's gonna keep assets as the asset class matures. And that was really the point of the Smart Contract Leaders Fund, as an example. Is we've got a lot of LPs who've done very well in these VC funds. A lot of times the funds have matured. They're looking for a way to deploy these assets into the asset class with maybe a little more beta and a little less alpha and more liquidity at a radically different fee structure. So that's our thesis for the index fund, at least. But early stage, seed stage, neutralizing for valuations, that seems to be, from our perspective, the best place to be, especially as a liquid, traditionally a liquid asset manager. That's where we don't have direct overlap, so it's not competitive, but we can still get good information and a powerful network from those VCs.
So you actually have brought up something a couple of times, which is interesting, which is beta, and risk management in crypto. So how do you actually think about risk management in light of digital assets? Because no one is talking about VAR or expected shortfall or any sort of or even modestly complex, portfolio risk analytics and data. How do you guys think about risk, both from a market metrics point of view, like a beta, but also from a more, like smart contract point of view, like a hack point of view or a counterparty view? Like, how do you view risk kind of holistically within digital assets?
The holistic view is that risk is higher, so prepare your clients appropriately. When one of my LPs said, I'm buying your fund because I'm prepared to buy more of it 50% lower. So that's the kind of LP that we like, who's ready for a wild ride, because we are kind of long directional. None of these strategies are delta neutral. These are long directional. That are going to work with the asset class. We don't think that the asset class is ready for a long short vehicle. The prices are just not efficient. There's too much volatility. So in the alpha fund, it's more of a long directional with ability to move into cash when things get overheated, and then just trying to manage the marginal benefits of diversification, especially in the smart contract index, where there's 10 or so coins. Are you getting diversification benefits versus adding tracking error? That's really the calculus that I'm trying to go through. And there's not a ton of diversification to be had in the altcoins, right? The correlations are generally 90% plus among the altcoins, and the only time you get some, very low correlation is when a coin is either an extreme dog or mooning extremely. So I think it's more strap in and get ready for a wild ride when it comes to like long directional strategies. Now, in the lending fund, where we're really relying on our counterparties to extend credit in a responsible manner, then the risk is more operational, in the sense that the onboarding process that we have with these clients, there's a lot of lawyer to lawyer talk, a lot of kind of the operational details that will give us more confidence that we're going to get our money back.
And so, one of the questions I had written for later, and I think it's relevant to go over it now, is, kind of talking about the future of digital assets and whether or not it's a multi-chain future. So obviously, you're managing a smart contract fund, right? Which, implies multi-chain. But, do you think it's possible to pick winners and losers in the smart contract space? Are there particular projects that have you excited? And in the long run, you mentioned that 30% of the fund is ETH or 40% of the fund, because naturally 30 to 40% of the smart contract market is Ethereum. Do you think we get to a point where there's one very, very dominant player, or there's a number of smaller players? Like, how do you see it shaping up? Or do you have no idea, which is why you're just like, let me index the market?
So if you look at the smart contract platform sector that we made, ETH by market cap is, call it 70%. The index that we designed, we cap a single coin at a max of 30%. So by definition, the index is a bet on a multi-chain future, because otherwise you'd be owning 70% ETH. Now, within that call, like, it's multi-chain. Okay, so what does that mean? So there's layer ones, right? There's monolithic layer ones, like Solana, and then there's modular layer ones like Ethereum or Avalanche, and both those architectures can play a role. So that's one type, layer ones. Then you've got your exchanges like Binance, which has its own chain, or Crypto.com, which is Kronos on the Tendermint chain. And they have reasons to make their own blockchain as well, so that they can optimize kind of their buyback and burn mechanism and some of the characteristics there. Then you've got your application-specific blockchains like Helium or the Graph, many of which are kind of switching to EVM compatible chains, some of which at least. So maybe that kind of gets subsumed into layer ones. But I'd say like those are the three categories that we like. Also decentralized infrastructure. And then, the categories or the sectors that we're maybe a little less certain on because they maybe don't have a path to, like, we're looking for projects that have a path to 100 million users, a strong moat, and predictable tokenomics. And when you look at categories like DeFi or like the execution layer of a smart contract platform, like the scaling solutions, or gaming tokens or meme coins, we don't find those three things, right? A path to 100 million users, clear token value accrual, and a network effect. So those are really the three characteristics that we're going for. To answer your question, there's so many chains that hit those three characteristics that we can only conclude that the future is multi-chain.
I really like your comment on building a strong moat, right? Building a defensible business. Can you speak to a couple of projects that because seemingly there have been a large number of projects in this space that have been, you mentioned DeFi, and I think that's a great example where, like, okay, Uniswap is the hottest thing ever, and Uniswap actually has a ton of users, but it's not a valued asset, right? And that's probably because it has a bad token accrual mechanism. But like, there are a lot of projects in this space that just don't seem to be defensible. An example being like, Axie Infinity or StepN, like they get really hot temporarily and then they kind of die and they haven't ingrained themselves in the lives of any of their users. And it turns out, well, they were just, fads. And so I'm curious as to what you think is a defensible moat in this space, and what you think will become defensible moats. Like what attributes of projects make them defensible?
Sure. So I guess I'd want to break that up into the supply side and the demand side. So like on the supply side, it's, are developers going to remain excited about this project such that they continue to iterate and build new functionality onto the chain. And that's where the layer ones have such a strong advantage, is because of how composable those chains are and how big the ecosystem of developers that's built up around them. So we have obviously big positions in ETH and Solana and some of the other L1s like Avalanche and Polkadot. So that's kind of a supply side argument, and then you wait for applications to be built on top of those chains and watch the fees and make sure that the fees are growing alongside the users. But then on the demand side for these application-specific blockchains, you want to see folks using the native token in order to buy that service. So like in the case of Helium, where there's been a lot of controversy about that project, but they're bootstrapping an IoT network from scratch by selling miners to folks who put them in their bedrooms, and then those folks are broadcasting IoT signals throughout their neighborhoods and kind of waiting for who's gonna be the software company that builds an app on top of that Helium such that everyone needs to pay Helium tokens to figure out the temperature of their sidewalk on any given day, and that killer app has been slow to materialize, so the token has underperformed. So you really want to find that intersection, I think, of where there's obviously big brains who are looking to build, but then we're looking for product market fit, where folks are actually using the token to transact.
Has there been any killer app? Because we talk about this, we've talked about this in the space for so long, is there has to be this killer app, this killer use case. And I would personally argue that stable coins are that killer use case for remittances and a few other reasons. But I'm curious as to, beyond just stable coins, if you think there's actually a real utility or use case of any of these things at this point.
I mean, I would argue that storing value on a censorship-resistant blockchain with a predetermined monetary policy, like that is the killer use case, right? Bitcoin is the killer use case because it makes people feel comfortable to hold an asset that they are confident will not be inflated away by unaccountable central bankers. So to me, that is a real use case. I realize it's not for many people.
I agree with you on Bitcoin, by the way, as well.
Yeah. So everything else is like a version of that. But I will answer your question more specifically.
Like anything built on Ethereum, right? Where you're like, this is a very clear use case and therefore should accrue value to that project, and then Ethereum kind of more broadly.
Yeah. There's some early stage projects that I think make the case well. One is Hivemapper. Have you heard of this project?
I haven't come across it yet.
So it's a Solana-based project. They are bootstrapping a Google Maps competitor. So you buy a miner, which it's an open source dash cam, which goes in your car, and you're driving around, and it's mapping all of your surroundings, and you're getting paid these honey tokens for your work. Then you've got your map curators who ingest all that data, scrub out the license plate numbers and whatever private information there is, boost the rewards in the geographies that haven't been mapped recently. So you incentivize your drivers to drive the regions that are under mapped. And like that's the supply side, right? And then on the demand side, you're looking for who wants to build the next decentralized Uber. Because if you look at Uber and Lyft, their cost of goods sold, a large percentage of it goes to paying licensing fees for Google Maps. Mapping is an oligopoly. 3 players have like 90% of the market, ridiculously high margins. You can spend $80,000 a month on Google Maps without even talking to a salesperson. So if you can get a decentralized alternative with a much lower take rate, someone, especially in emerging markets, will want to build this next Google Maps. And there's other projects that are kind of variations on that theme. I think like even basic attention token, the Brave browser's advertising network is a variation on that theme. Tokenomics for some of these projects need to be refined a little bit, but I think that's one pretty clear example of a real world use case.
Yeah, I mean, I've made like $120 on Brave in the last 3 years. So, never sold.
Now, are you selling it or are you holding it?
No, you got to KYC to sell it, and I could never be bothered to KYC for $100. But maybe at some point, it's always in my head. It's like when it hits this amount of money, then I'll finally go through all the effort to actually get my Brave out into dollars. it's definitely.
Yeah, I mean that's one of our question marks for the token is like, what will it be used for, such that people don't automatically sell it every time it comes into their wallet?
The greatest thing it has going for its token economics is the fact that you have to KYC. Because if you didn't, it would be sold way faster.
Well, we'll see, because they're coming out with a DEX, and their new wallet has some better functionality. So if you can start to use this as collateral in DeFi, or to your point about stable coins, maybe there'll be a stable coin version that you can use to buy more ads or what have you. Like, that could be quite powerful.
And so we've talked a lot about crypto. But you started in this role as head of digital asset research about 1.5 years ago. So what has been your favorite parts about being in the space, and kind of your least favorite things about being in crypto?
It's probably the same answer for both, which is just the speed and the dynamism in the space. Trying to equity investors are used to having the world served on a plate to them by brokers who are basically in their inbox every morning offering, conference calls with this executive, or here's this research that we've done. And it's all very, it's fast moving and ever changing.
Well, in crypto, it's decentralized, which means it's totally disorganized and it's all over the place.
Correct.
I like that we use decentralized and disorganized as synonyms in this space. Sometimes it feels like.
Yeah, exactly. So, I mean, that's both my most favorite and my least favorite, right? Because information is highly fragmented. So there's a lot of alpha if you can get to it early and get conviction. But at the same time, I have to build the Catalyst calendar from scratch. There's no Bloomberg page to just hit in calendar and look at the menu of things going on Wall Street that day. So, yeah.
Stay tuned, wink, for anybody who's a client on the call. You spoke a little bit to things from traditional finance, right? Like having a prime broker and get soft dollars and all the value that prime broker is offering to you, right? But how does your experience in traditional finance help you in understanding and analyzing digital assets? Like, what have you taken from your role as a more traditional PM and kind of brought into digital assets?
It's a good question. Sometimes I wonder if there's anything of use, but I think there are certain similarities in all asset classes. You have to imagine what the world might look like in 3 to 5 years. You have to try to handicap those outcomes in probability terms. You have to try to identify the securities with the most exposure to certain themes. And then you have to try to figure out how your competitors are positioned so that you avoid overcrowding. I'm sure you and much of your audience has read the book Super Forecasters. There's basically 3 behaviors that correlate with success in this business. You have to be open-minded. You have to make forecasts and probability weight them, and then you have to update those forecasts frequently in order to measure how things are proceeding against your assumptions. And of course, all that is easier than it sounds because of all the behavioral mistakes that are kind of hardwired into ourselves as humans. But from that perspective, I'm investing in coins with a price on the screen, and the price is always changing. And I think some of the same patterns go into managing money, no matter what the asset class is. And then the other thing that we've tried to do is really bring like a traditional DCF approach to valuation. So all the coins, most of the coins that we own, we have financial models on, and we assume a certain free cash flow yield in 2030, incorporating our expected inflation rate of the token at that time in order to level set our valuation approach. And there's a fair bit more guesswork in coming up with those models. Sometimes we're debating what we think the tokenomics should be because they haven't arrived there yet. But that's part of the fun stuff too, because then we can get on the phone and talk to some of the entrepreneurs who are building these projects and have a little give and take about that. So in that sense, it's maybe similar to
you have more access and opportunity to work with the crypto native issuers than you did to work with issuers, when you're an equity, PM? And are they receptive to feedback on the token side?
It depends. So some teams don't want to talk about it at all because they are attuned to the legal risks around marketing a security or non-security. So you've got some teams that are, really close to the vest, not that accessible, and I think, opaque for the right reasons, which is that they themselves don't know and don't want to get into trouble by promising something. So those projects are a bit more challenging to model. And then earlier stage projects looking for, a seed stage check or a Series A, obviously much more receptive to ideas from their investors.
And so a question that we ask everyone on the podcast, it is the Fundamental Value podcast after all, is how do you define fundamentals for digital assets? And does it depend on the token? I think we've hit on this a bit throughout the episode, but it would be great to get your thoughts there.
It definitely depends on the token. We're number go up investors. So we're looking for free cash flow and we're modeling these target prices based on this inflation adjusted free cash flow yield in 2030. So you got to find what protocols are going to be so valuable that users will pay to use them. And, that's not Dogecoin and Shiba Inu. That's layer ones, exchange tokens, decentralized infrastructure, for the most part. And then, we want to invest in projects post product market fit. So they have users, they have a business model, and now they're just looking to scale. So we like to identify, what are the handful of KPIs that are likely to correlate most highly with fees, and then track the fees as they come. So for layer ones, as an example, right, you want to look at the number of transactions, the number of active wallets, the number of active dApps, the development activity. So how quickly are folks hitting the GitHubs, and then the TVL. And those 5 factors have the highest correlation with price, and we think at least the highest correlation with for future fees. Although some of them are less mature on the fee from a fee perspective.
Yeah, I mean, I think that's totally right. The challenge, I think, in this space, and obviously as a data firm, right, slightly biased when I think the challenge is, but the challenge that I always have is, how do you actually compare the number of transactions across chain? Like, what actually is a transaction? How do you actually define a transaction? What's the actual mechanism and stuff like that? So I think you're totally right. Like, you have to come up with the best. It's always about coming up with the best alternatives, right? When you don't actually have, traditional metrics that maybe make a bit more sense. It's always like, what is the alternative metric that we can find on chain to kind of understand this asset? I think the challenge that we have a space, and it's a thing that we're trying to tackle, but I think it's something that as a space you need to tackle holistically, is figuring out like, okay, what does this actually mean, right? How do you define a transaction? How do you define an active address? Like, I think a great example of this the other day, I'm sure you saw this, the Solana, the Saber founders who faked being, by the way, totally incredibly impressive. They faked being like 12 developers at the same time and like faked 8 billion of the 11 billion in TVL on Solana, or, so they claim. And so, curious as to, your thoughts, I guess, on that issue more broadly, if you think it's been a challenge for you, or, I don't know if you have any thoughts on it. If not,
Yeah, I mean, data, getting good data is probably the biggest challenge in this space. And I use the TIE terminal. I think it's excellent, but I have to use everything else as well because no one provider is really has enough fundamental coverage of all the major coins so as to make these apples to apples comparisons. So
it's very, very difficult. Like,
I sympathize with you, my man.
It's just that the challenge there is with everything else, with all the data except for blockchain data, it's very easy. But with blockchain data, the major challenge for anybody listening and anybody who's curious is the fact that the data structure on all these blockchains are totally different. Like, anything that's Ethereum compatible, EVM compatible, you talked about that earlier, is fantastic. If you're a developer, please build something EVM compatible. It makes everyone's life so much easier, at least from a data perspective. But the challenge is the structure of all these blockchains are totally different. For example, like a random chain, which a lot of listeners may or may not be fans of, but no opinion, just a fact, Cardano doesn't actually have a token standard, which means that if you wanted to do all the on-chain data on Cardano, no matter what you think of it, you'd actually need to connect to all the individual APIs of every single project that's building on top of Cardano, which is insane. Like, it's an absolutely, it doesn't make any sense. Like, Ethereum has ERC20 tokens. Cardano doesn't have a token standard. And so it's like practically impossible to do that. So I think this is a challenge, which is, it's not a money challenge. It's a time challenge. It's going to take somebody a lot of time to actually fully map all of these things out, but it's coming. I think a lot of progress has certainly been made, but I think to your point, a lot is left to go. And especially like, okay, now Aptos is here and all these new chains are here. And now this is just compounding to the ever-growing problems that we have. And I think another, related challenge is just the fact that every day there's a new layer one that people are excited about, right? And it's like, okay, Solana is super hot this year, so now we have to support it. Oh, wait, now it's actually Cosmos is getting really hot, right? And it's kind of like this hip hopping. But in a similar and related point to hip hopping between the trendiest chains, fast forwarding 24 months from now, looking at the top 100 assets that exist today by market cap, how many of those are still going to be here? And why are different coins going to be in their place?
So how many of the top 100 cryptocurrencies by market cap will still be in the top 100 in 5 years, you said? Or two years? Okay.
By the way, for anyone who hasn't done this before, really recommend checking out CoinMarketCap. Actually has this thing. It's called I don't know if I could find it. It basically allows you to see the history. You can actually go back in time and see, like, it's like their version of the Wayback Machine, where you can go back in time and you can go to like 2017 and see what the hottest coins were. So I'll post the link in the description. Lots of fun. But yeah, curious as to your thoughts, and I'll see if I can drop you the link in the middle of this call as well.
Yeah, I would say like 60% probably would still be in the top 100. I think that we've made good progress on weeding out at least some of the scammier coins, and we'll see meme coins kind of fade down the list of top tokens, but then every once in a while you'll get a big airdrop, right? So associated with this ETH merge, we're likely to have a hard fork and a new Ethereum proof of work coin with considerable market cap, judging by the futures markets, and that will probably keep some market cap for quite some time. So it's not like of the 30 or 40 that will replace the top 100, like not all those will be stellar projects either. There'll be some weirdos in there as well.
Yeah. So by the way, for anyone listening, I just dropped you the link. It's coinmarketcap.com/historical. But I just pulled up literally 2 years ago from today, looking at the top 100 tokens, and it's a bit of a shit show, especially towards the end. Idea Chain Coin, Advanced Internet Blocks. There's a lot of interesting ones in here, but the top 20 are still, for the most part, there. They've moved around quite considerably, but they're definitely still there. So kind of fun to play around with. And so let's kind of get into something a little bit more timely, the Ethereum merge. So what are your thoughts on the upcoming Ethereum merge, and what will happen to ETH's price after the merge happens? A lot of people are speculating that ETH is going to sell off after the merge.
So it looks like the merge is getting de-risked quite a bit. The most likely scenario is that we are go for September 19th, although this Friday, August 12th, I don't know when this is airing, but there's going to be another Ethereum core developers call, and we should get either like more confirmation or clarification around that September 19th date. It's hard to predict what will happen after the merge without predicting what will happen before. But if we look at the September futures contracts for ETH on Deribit and the other derivatives exchanges, you can immediately observe the directional bias in this market. So there's overwhelming demand to purchase calls at a premium. We're now seeing backwardation. So when the futures curve is lower, the longer out we go across both ETH options and futures, which is quite rare. We're seeing more volumes in ETH derivatives than we are in Bitcoin. So all these point to quite a bit of optimism creeping into the Ethereum market. But then if you look at October in the futures market, the implied volatility for Ethereum is higher for downside price protection than it is for upside. So people are paying up for downside protection in October. So I guess you could say the consensus is that ETH will run up into the merge and then sell off. But I think there's also the possibility, right? So one popular trade right now is to buy ETH and then short ETH futures. And you can do that delta neutral because the contract expiry is in September. And since the ETH spot holders are likely to collect this airdrop of the new proof of work ETH chain, it's essentially free money to short the futures and buy the physical, collect that airdrop, and then close out the chain. And then, Chainlink announced today that they won't support the new proof of work chain. So I'm guessing we're going to get everyone in a rush to sell that ETH1, the proof of work chain, and then maybe that money flows into the new Ethereum proof of stake chain. And so maybe the sell-off post the merge is not as bad as everyone is expecting. So that's kind of how we're thinking about it, is that it's a fundamentally bullish development for ETH because, first of all, just de-risking what has been years of execution in the making, and second, the more pronounced disinflationary characteristics that ETH will have post proof of stake. So it deserves a higher multiple and it deserves a higher price. And then we'll just see how folks are positioned afterwards and whether a new narrative has emerged and whether we're in a bull market where everyone can feel confident to then try to find, the next kind of high risk development in this space.
And you actually alluded to a bunch of things which relate to my next question, which is, what do you think of the proposed ETH forks? Like you mentioned, Chainlink isn't going to support it. Is any projects, do you think, going to support the proof of work forks of Ethereum, or the existing chain? Kind of curious to your thoughts there. Does anybody care other than the miners?
Well, if the miners care, that's enough to get some of the ecosystem on board. So I don't think it's going to be a terribly dynamic ecosystem. I don't think there's going to be a lot of smart contract functionality going on or really exciting apps that people look to build. But we can see from Ethereum Classic, it's still $6 or $7 billion in market cap, still a pretty vibrant miner community. And I could see that lingering in the ETH proof of work chain for some time. Although from my perspective, it doesn't really fit into what I would consider to be a smart contract leader. So I can't see holding it without a change in the reality.
And so what in crypto has you most excited right now?
I mean, I'm always excited. I'm excited about Bitcoin over the next 18 months. I mean, I think Bitcoin's the tail that wags the whole dog. I don't think that the proof of stake chains are going to work unless Bitcoin works. And I think we've gone through a brutal year-long bear market that was, partially a result of a change in monetary policy and a change in the inflation outlook, but also importantly, a pretty negative political backdrop. We've had 2 years of a very progressive administration in the U.S. just pounding this asset class with bad news after bad news. And I think that's going to change, starting in November and then leading into 2024, which corresponds with the next Bitcoin halving. There's 8 million people in the world right now who live in countries where Bitcoin is legal tender. I think that goes to 80 million over the next year and a half as more countries kind of realize the geopolitical dynamics and embrace this like neutral energy-backed money. And as that happens, there's going to be a lot of excitement around the proof of stake chains and all these applications, whether it's hivemapper or Helium or the graph. They're going to start to see an acceleration in adoption and 100 million people users heading on chain because of the Bitcoin bull market, which is going to give everybody the confidence to bank with Bitcoin as the reserve asset.
And so my final question is, what is your most controversial take right now?
I'm sorry to repeat it, but I think my controversial take is that the number of people who live in countries where Bitcoin is legal tender will 10x in the next 18 months. We've had 2 countries with 4 million people each, and the next one will be an order of magnitude higher. I don't know whether it's going to be, in Ukraine or Latin America or Africa or the South Pacific. But when that happens and when the politics change, and they always do, then the narrative will be very different, and 100K Bitcoin will seem cheap.
Thank you so much, Matthew, for coming on. I really enjoyed this. I learned a ton. I partially do these episodes to ask questions that I wouldn't otherwise be able to ask. So I appreciate you letting me pick your brain today. And so where can listeners find out a little bit more about you, follow you online, but also about VanEck? And we'll make sure to put all those in the show notes as well.
Sure. Yeah, we have a VanEck digital assets page. So if you just type in VanEck digital assets, you can sign up on our distribution list. You can follow me on Twitter, Matthew_Sigel. I should also note that VanEck has a community NFT project. So we airdropped 1,000 NFTs. We had 50,000 Ethereum addresses. We collated the list down to 1,000. These NFT holders get early access to our research. They get to attend our events where you're going to see those NFTs deployed in some interesting metaverse applications coming up. So please find the VanEck NFT, follow me on Twitter, and sign up for our distributions for all the info.
Awesome. Thanks for coming on, Matthew.